Hello, welcome to America First Wealth Management Investment Outlook for Monday, April 14th, 2025. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First. This is our standard disclaimer. This material is intended for information purposes only, and we're not offering any investment advice. We're recommending to purchase or sell any securities. And these opinions expressed as of today and are subject to change without notice. And certainly as information changes, our opinions may change. So this is just our standard disclaimer. Thanks. So we'd like to begin market highlights. Last week, we saw a major index rebound. So the best weekly performance for major stock indices since 2023. And this is following a very sharp downturn earlier this month. We saw some dramatic policy shifts with respect to tariffs. President Trump announced a 90-day pause on new tariffs from most countries, excluding China. This was late last week. Bond market experienced high volatility. Treasury yields experienced historic increases, with the 10-year yield rising 50 basis points. It was the largest weekly jump since 2001. So a strong tech sector rally as a temporary exemption from tariffs on key tech products, including smartphones and semiconductors, spurred a huge rally in tech stocks. Now, how does this translate to our market outlook? We think that unpredictable changes in tariffs will result in continued market volatility. In our opinion, China appears to be bracing for a longer-term confrontation with the U.S. They are ignoring further U.S. tariff increases, and they effectively declare that U.S. goods have no market demand in China. They've suspended exports of rare earth elements that are critical in high-tech industry. That is troubling. Also this week, Xi Jinping is personally visiting Southeast Asian countries. And meanwhile, in Washington, many countries are visiting the White House, negotiating trade deals with the Trump administration. U.S. companies whose businesses are impacted by tariffs, we believe, are likely to reduce their financial guidance. Right now, in terms of technical indicators, markets appear technically oversold and fundamentals are weaker given by the events that are occurring. We do believe that bad news is priced in, and any good news could lead to sharp short-term rallies, which is kind of what we're seeing right now. Also, a major concern for us has been that there's a disproportionate amount of U.S. debt relative to total debt, public debt, is maturing this year. We'll talk more about this later, but we believe this supply imbalance will pressure interest rates. This is a shortened week with the markets being closed on Friday for Good Friday. In terms of key macro indicators, on Monday, consumer inflation expectations for March. We're recording this right now, midday on Monday. So we actually saw the numbers 3.6%, higher than the forecasted 3.3%, and also higher than the previous number for February of 3.1%. Tomorrow we have the Empire State Manufacturing Survey and import and export prices for March. Wednesday, we'll see U.S. retail sales for March, industrial production, business inventories, and home builder confidence data. Thursday will be initial jobless claims for the week ending April 12th, housing starts and building permits for March, and the Philly Fed Manufacturing Survey for April, and also occurring on Thursday, it's the ECB's interest rate decision. We are starting to see more earnings reports from S&P 500 companies. This week we see 31 companies. We have 10 financials as listed here. These are key bellwethers: Goldman Sachs, Bank of America, Citigroup, M&T Bank, PNC, US Bancorp, American Express, State Street, Blackstone, and Travelers Got three healthcare companies, J&J, United Healthcare, and Abbott. Got three major tech and communication services companies, Netflix, Taiwan Semiconductor, and ASM Lithography. Got a couple of industrials and transportation, United Airlines, Delta Airlines, and CSX Rail. And materials and real estate, we have D.R. Horton and Alcoa reporting as well. So a lot of companies will be focused on what they're going to be saying about their outlook and impact with respect to tariffs. As we said before, we're likely to see companies raising warning flags and tempering their expectations. Turning to weekly market stats, we saw a sharp rebound for the week. As you can see, the Dow was up 5.92%, S&P 500 up almost 6%, NASDAQ up, and NASDAQ 100 up over 7%. So small caps lagging up, but still up 2.8%. Large growth also led up 7.5%. Value lagged a bit, 3.4%. Growth, small growth, and small value. Growth was up, small growth up 3.3%. Small value lagged only up about 20 basis points. International stocks rebounded sharply as well, up 5.3%, measured by EFA. And due to the sharp rise in interest rates, the iShares Core US Bond ETF was down 2.4%. Month to date, we continue to be in the red across all major indices and international and bond. The year to date and the 3-year, as you can see, mostly red, with only international and bonds being up. So it's been a challenging year to date so far, but a sharp bounce due to what we believe is the technical oversold, and any good news is probably likely to result in a sharp bounce in the markets. Looking at the Magnificent Seven names for the week, we're led by the sharp bounce in NVIDIA, 17.6% for the week, followed by Amazon, Meta, Tesla, and Apple. Microsoft and Alphabet also did perform quite well. It's a very sharp bounce in the Magnificent Seven. However, as you can see, year to date, numbers still look pretty weak, with 5 out of the 7 names down double digits year to date. This is in contrast to strong 2024 and 2023 results. Turning to U.S. sector performance for the week, led by tech, industrials, and financials. The only sector that was down was real estate, down 10 basis points. As you can see, month to date, quarter to date, and year to date, most of the indices are in the red, the only exceptions being defensive sectors, consumer staples, and utilities, the only sectors that are green year to date. Turning to a chart of the S&P 500, we note that the peak to trough drop from the high in the S&P this year, we've lost about 18.9% to the bottom, but a sharp bounce off the bottom. The vertical line we're showing there is Inauguration Day, January 20th. You can see that the S&P has sold off after a slight gain since inauguration, but then hitting a peak and dropping dramatically, largely due to the tariff announcements by Trump and a lot of activity by this administration. So, as we noted before, oversold on the technical basis, but any good news should result in some sharp corrections here. We were below the 200-day moving average, which is shown by the purple dotted line, and now we're slightly above it with the recent bounce. The overall trend, though, still looks like it's down for us, but there will be sharp corrections like this. This could be indicative of bear market rallies, which we're cognizant of and need to be wary of. Until there's some policy stability in terms of what the government um, is establishing in terms of rules and regulations. We think many businesses and business leaders will be hard pressed to establish long-term business strategy given this volatility. More likely than not, we think businesses will be trying to cut back on expenses, spending, capex, and investing for growth in this environment, and they're going to keep their powder dry, especially since things like the dollar index is shown here is quite weak. We're at a support level for the dollar, as you can see. And if we break below this, that will be troubling because we do feel that a stronger dollar is better for the U.S. economy longer term. A weaker dollar may bolster exports, but given the tariff wars, um, that even a weak dollar may not increase exports for U.S. goods. Turning to Bitcoin, as we noted before, the 200-day moving average was an upward trend, and even though Bitcoin came down to it, we felt that it would hold that support, and Bitcoin was oversold, as you can see by the RSI, and starting to hold in there and recover a bit. Gold, as we mentioned previously, looked like a very strong chart to us and supported by strong fundamentals, a weaker dollar, and the trade and tariff war certainly has created a historical opportunity for gold, and certainly gold has reacted by investors on a flight to safety, pushing gold to an all-time record high above $3,200 US per ounce. We do believe gold continues to be positioned to increase higher, and it is seemingly the safe asset right now, whereas in the past we've seen U.S. Treasuries and U.S. dollars being the safe flight to safety asset. Gold appears to be that asset du jour for the moment. Turning to the 10-year Treasury yield, so you see the sharp bounce for the week, up almost 50 basis points, ending the week at 4.48, up from 4.01, up 47 basis points. Year to date, yields are down only slightly, down 10 basis points versus the year-end 2024 4.58. This sharp movement in a very short time certainly is troubling, and we certainly need to monitor Treasury yields and how it will impact the economy going forward. Turning to yield curve, we can see that between April 4th to the 11th, a huge move up in rates pretty much across the yield curve, except at the very short end, but a very sharp increase in interest rates, and that tends to put a stop on economic growth activity because it just reduces liquidity and borrowing activity. And we talked about this before, but here's some data that supports it. There is a disproportionate amount of U.S. debt maturing this year. This is off Bloomberg in terms of the debt distribution by maturity. There's 9.2 trillion of government bonds maturing in 2025, and this is out of 36.2 trillion in total public debt. So this is over 25% of the public debt is maturing this year. And that's a supply that needs to be reckoned with, and the U.S. will need to finance that debt, and higher interest rates will only cause interest service to be higher in the future, and that would have a dampening effect on economic activity. Turning to the economic calendar, just to again highlight what we stated before, consumer inflation expectations, which are already reported. Do have a number of Fed governor speeches later today, and a couple of auctions at the short end of the Treasury market. On Tuesday, we've got the export and import prices, New York Empire State Manufacturing Index is shown here. Turning to Wednesday, it's the usual mass reporting of the Wednesday data as we see every week. The key data point we're looking at on Wednesday will be retail sales at 8:30 a.m. Previous was 0.2%, consensus is 1.4%. So we'll see if there's any tail off in retail sales. We do suspect there may have been a pickup as investors are buying to hoard ahead of the impact of tariffs, but we'll see what happens. It'll be a tough one to interpret. A strong number doesn't necessarily mean that things are fundamentally improving. It just could be pre-buying in anticipation of higher prices. Turning to Thursday, we've got some real estate data, building permits and housing starts, and Philly Fed Manufacturing Index. And we also have a couple of Fed governor speeches, Barr at 11:45 a.m. And on Friday, being Good Friday, there's only one Fed governor speech by Governor Daly. Turning to the S&P 500 company earnings, we highlighted the list before. I'm not going to run through these in detail. We do have Goldman Sachs reported positive numbers this morning. However, their guidance was somewhat muted, so that's kind of to be expected. As we mentioned, M&T Bank had a slight negative surprise, as noted here. Tomorrow we see two banks, three banks actually, and J&J. And after close tomorrow, JB Hunt, Omnicom, and United Airlines. Turning to Wednesday, Abbott Labs, Citizens, Financial, Prologis, Travelers, U.S. Bancorp reporting. After close, CSX and Kinder Morgan. Las Vegas Sands, Market Access, and Progressive reporting. Thursday, again, a lot of financials reporting on Thursday, and we have home builder D.R. Horton and healthcare United Health. After the close will be Netflix, Unspecified of Blackstone, and Marsh & McLennan. And that's it for this week. As we said earlier, expect a lot of volatility as government policy remains unstable and somewhat volatile as the Trump administration attempts to negotiate more favorable trade deals across the world. And many countries have sent representatives to the White House to negotiate these deals. Typically, these trade deals take a long time to do. The Trump administration has asked for a 90-day pause on these tariffs, thinking that they'll get a lot of these done in 90 days. It's going to be a lot of work. We wish them success, but hammering out trade deals typically take longer. We would not be surprised if the pace of trade deal negotiations takes longer than expected. And the longer these things drag out, unfortunately, means that policy is not stable and investors will continue to be on the sidelines and be cautious. So we're of that opinion that this is a time, as we noted before, Warren Buffett sitting in Omaha on one of the largest piles of cash Berkshire Hathaway has ever raised, over $350 billion, waiting patiently for better opportunities. We do advise that um, most investors do the same, keep dry powder. We've had two very strong years in the market, and until there's some stability in policy and greater clarity in terms of where things are going, and also we need to wait for a lot of the treasury debt to be refinanced this year, which is likely to create some pressure on rates. So it's a good year to find that safe assets might just be cash and gold, or for those who believe in crypto, that might be another safe asset to be. But this is the time to seek out investments that are fundamentally more stable, less dependent on um, foreign business opportunity, and it's a good time to pay attention to the news because it does seem to be changing on a daily basis. For those who are more nimble, there'll be some quick investment opportunities, we believe, and some opportunities to buy great assets at tremendously attractive valuations. But for stocks that are momentum or overvalued, um, it probably pays to be cautious as well. So that's it for this week's report. I'm Dan Liu. This is my email is noted here. You can reach out to me or Jim Monahan via our emails if you'd like to set up a private call or meeting. We're happy to meet with investors or prospects. So thanks for tuning in. Have a great week. Happy Passover, Easter holidays if you're celebrating that this week. And thank you, and we'll talk to you again next week. Take care.